Over the past few decades, financial press has really been on the rise. For example, these days you get 24-hour news broadcasts, for example on Bloomberg, about investing. Now, this may sound like a good thing, right? More news about investing, more access for everyone to investing. Isn't this a good thing? Well, no. It's actually a very bad thing for you as the investor. Now, the benefits of it are valid. Obviously, it does bring um investing to more people and stuff, which is good. I mean, it helps more people to be able to actually retire, for example. But let's look at the downsides of it in this video. I mean, first of all, and this is the really obvious one, if you're watching financial TV, you're not going to be having time to actually read about stocks you want to invest in because you're going to be spending time on this. So it wastes time. And this may seem like you're doing a productive thing. For example, like you're watching a channel about investing, so you're like, oh, I'm actually learning something. But usually, because of 24-hour coverage, most of the stuff you see on TV is rubbish because they have to keep like a low baseline of stuff for their 24 hours, right? So that they have enough stuff to show all day, every day. So obviously that stuff is not going to be quality, the stuff that you can see in 30 minutes or an hour, because it's been spread out and drawn out across a whole day's worth of broadcasting. The next thing about financial press and financial TV and stuff like that is you have a constant ticker of stocks going by if the price has gone up by 0.1% or whatever. And this might seem like a good thing, right? You're informed. But actually it's a bad thing because investing is a process that takes time. And often there are bumps along the way to your stock doing well. So even if you invest in a good stock, maybe one day it goes down 5%, and this makes you panic. So this could cause you to sell your stocks on a downward trend, when in fact it's just a little blip in their upwards journey, which could cause you to lose a lot of money if you're someone emotionally inclined to listen to these press things and see the red arrow going downwards and be like, oh no, my stock is completely bad. So this might cause a lot of anxiety and thus loss of money for many people because they're just constantly assaulted by this ticker that's telling them if their stock's gone up a bit or down a bit. And all these analysts telling them, okay, your stock's a bad pick now or a good pick now. Whatever. Even though they know that it's a good stock because they've done their homework, they might be tempted to sell it, causing a massive loss to them. I mean, think about all the times the press has been wrong in their predictions. Like, think about the dot-com era, where the press was loud hailing every new tech startup that had a little .com in their name, sending the prices way up, even though there was nothing behind the companies. And so normal stock prices of actual decent companies that had a good track record and were good companies to invest in were sent way down, which might have sent a lot of people out of those stocks, even though those were the ones you should actually be invested in. And then after people started to realize, these .com stocks have nothing to them, and started disinvesting in them, and the prices plummeted, causing a whole crash in the market. That's when the actual stocks that were good, people realized, oh, these stocks were actually good, we should have been investing in them the whole time. So financial press is usually, I shouldn't say usually, but it is very often wrong. And really, they shouldn't be trusted with your money. You should do your own homework on stocks instead of trying to rely on someone else to give you analyst predictions, because they're wrong just as much as the rest of us. They might have a fancy PhD in front of their name, but investors and analysts are very often wrong, and very often just jump on the hype train of a stock instead of actually looking at the fundamentals of it and deciding whether it's a good or bad investment. So, if I were you, and I'm just saying this because I was reading this book called Richer, Wiser, Happier. I can't remember the author, but I'll try to link it in the description. But anyway, in this book, the author talks about a lot of successful investors. And a common theme with them is that they don't give themselves access to constant tickers and constant stock price updates, or at least limit their access to it. Now, this helps them to be less emotionally driven by the ups and downs of like minute by minute stock prices, and helps them to focus on investing just based on fundamentals rather than the whims of the day-to-day market. And you should be doing the same. Limit your financial TV/financial YouTube time, unless it's someone teaching you about actually new investing tips, like me, for example. Don't watch analysts predicting stuff that might never come to pass. I mean, sometimes they'll be right and make you a fortune, but other times they could be wrong and make you lose it all. So, if you get anything from this video, it's that financial press is not such a good thing after all. In fact, many very rich investors try to avoid it as much as possible, and they cite it as their reason for success. So, limit your intake of financial press. Anyway, if you enjoyed this video, please consider subscribing, because it would really help this channel out and help me to push fundamental investing to more people. Anyway, if you enjoyed this video, please do like, because yeah, that would really help me out. Anyway, thanks for watching, and I'll see you next time. Bye.